Okay, good evening, ladies and gentlemen. Thank you all for coming out this evening. I really think that you're in for a treat. I think most people who introduce speakers always like to say it's a particularly opportune moment that we're talking about this subject, but in some cases that's true, in some cases that's not true. Tonight it's very true. I think you've all been reading about what you're going to be in the news and watching it over the past several weeks about the fall of banks and the effects of our monetary policy, not only on our domestic economy, how long we might be in a recession, which I got to hear tonight's speaker expound on this on CNBC just yesterday and today. But this is not just an academic discussion. I hope you won't consider it an academic discussion or even a discussion by a very well-recognized expert, U.S. and international expert on the subject, but also on subjects that affect your life. And interest rates affect all of our lives, whether we fall into recession. You all have, or many of you have your portfolios to be concerned about. So we'll hear a lot about how monetary policy not only affects the U.S. Economy, but how it affects the international economy and how financial events and developments overseas affect the U.S. economy. In the ride in from the airport, we weren't just talking, Mr. Lockhart and I were not just talking about Silicon Valley Bank, but also Credit Suisse, which has an impact on all of you. So we're really very, very fortunate. The first thing I want to do, as we always do, is to thank our sponsors. First, our platinum sponsor, which is the Kreitz Auto Group, which has been serving us in Savannah and the Coastal Empire area for over 80 years, the exclusive local dealer for Buick, GMC, BMW, Mercedes-Benz, and Sprinter vans, and the purveyors and servicers of new, used, and pre-owned vehicles. So thank you very much, our long-term sponsor, Kreitz. I also want to take a moment to thank our in-kind sponsor for this program, our April program, which is the World Trade Center of Savannah. It's an international business and trade development organization that exists to create jobs and attract investment by helping businesses in Southeast Georgia grow internationally and identifying foreign direct investment opportunities for the region. I had the pleasure, along with, at the invitation of one of our other board members, Antoine Smoke. Where's Antoine? He was here. I think he'll be back. Who works for the World Trade Center, doing a great work in bringing investment and trade opportunities to the Savannah area. As a member of the World Trade Centers Association, the network that the WTC at Savannah runs includes 300 offices and internationally in over 100 countries, and is fostering global connections and provides integrated trade services. The next thing I want to do a short introduction and a short program on something that is near and dear to my heart. As you know, the council sponsors scholarships to students in the area to help them with international related programs that they might be going studying abroad or trips of differing degrees. And I always tell students or people that I mentor that going overseas, whether it's for a year or 6 months or a couple of weeks, can really be a life-changing experience, and certainly a career-changing experience. It was for me, it is for, but even if you don't go into the foreign service like my wife and I did, it really does change and open up new opportunities. And I always tell students, even if you don't, whatever you do, private sector, public sector, and the NGO work, teaching, whatever you do, if you add an international component to it over the years, your life will be much richer. So we're fortunate to have one of those scholarship recipients here tonight, Benjamin Merkinson, who attended Nagoya University in Japan last fall of 22. So let me ask Benjamin to come up here briefly and to talk to you a little bit about what he did during his time in Nagoya, Japan. Benjamin, please.
All right, so yes, in late August of 2022, I was fortunate enough to go to Japan, which was quite a treat because I got to go there about a month and a half before the country opened up to tourists. So it became quite an exclusive event. And as you can kind of see from this large list, I went basically everywhere I could, from, if you can see it, Tokyo, there on the right in the middle of that brown circle, all the way to that small yellow island between South Korea and Japan. Pretty much everywhere between those two spots as I could, which is where most of Japan is. Along the way, I had way more experiences than I could ever possibly convey, even in like a multiple hours long talk. So I'm going to just give the most basics of them. So right there you can see me at the sumo ring in Fukuoka. Yeah, I'm carrying art that I had purchased right before then, traditional Japanese art. And then also you can see a temple in fall in a picture that I took, which makes me feel like much more of a professional photographer than I actually am. But so I learned a lot of things when I was there. Primarily, I was there to learn Japanese language, but I also have a very vested interest in particularly Japanese religion and philosophy, and so I also got to learn a lot about that while I was traveling and learning, and I even gained a nickname from it. So my name is Benjamin, but the Japanese word for a shrine, a Shinto shrine, is jinja. So I went to so many shrines and temples that my Japanese friends took to calling me Jinja-min by the end of my trip, which I quite enjoyed. But so yes, I saw as much of the country as I possibly could. And that included seeing many historical sites, such as the Hiroshima bombing sites, to the castles of the men who unified Japan in the early 1600s, to modern-day Tokyo and everything like that. But how you guys helped was by contributing to my finances during this trip. I was able to learn not only Japanese more effectively, but learn how far I had come. So in the beginning of my trip, I would go out to places and meet people and talk to people, and I would have to translate, or there would have to be somebody who could speak English, and it was pretty tough, but then I still had a good time regardless. But then further on, as I went on these trips that I would not have been able to do had I not received this scholarship from you all, further on I was able to have more and more conversations with people and learn more, and I was able to see the progress that I was making in a way that I wouldn't have otherwise, because it was outside of the academic setting, so people didn't know how much I had learned and weren't trying to accommodate me for that. So it was a very interesting experience. But with that, I would like to leave on one final note, which I would just like to tell you all, which is that, these are called omamori. And they are basically good luck charms that you can buy in pretty much any Japanese shrine or Buddhist temple in Japan. They often have, there's writing, there's things inside of them that hold particular value, and they give you good luck and all sorts of things. And there's omamori for pretty much anything from cooking to learning how to drive. But I bought an omamori from a shrine that was for richness or like financial security. The day after I bought that, I got a direct deposit into my bank account from you all. So take that for what you will, but thank you very much. Arigatou gozaimasu.
I cannot top that. We're very happy that we have so many students here. We cannot guarantee you direct deposits into your bank accounts as part of your association with the Savannah Council on World Affairs. I hope that's working okay. As I said, ladies and gentlemen, we really it's a real treat this evening to have our speaker here, Dennis Lockhart, and I'll talk briefly about his background, but I also want to stress to you, if you look at his career, there's the private sector, there's the public role as Federal Reserve Bank Chairman of Atlanta, but there's also a real giving back to the community, I believe, too, by his interaction with students. Before he became a central banker, he was a member of the faculty of Georgetown University's Wall School of Foreign Service, chairing a master's program there on global commerce and finance and business government relations. He was an adjunct professor at Johns Hopkins School of Advanced International Studies, another one of our premier international relations graduate schools, and also chairman of the Small Enterprise Assistance Fund, a sponsor of emerging markets, venture capital, and private equity funds. He had come there before that as a managing partner of a boutique private investment firm with activity in Africa and in Latin America, and president of the Heller International, a group, a financial firm with activities in Europe, Asia, and Latin America. In the year 2000, he chaired the advisory committee of the U.S. Export-Import Bank. He had begun his career at Citicorp and Citibank, now Citigroup, and with extensive international experience in Lebanon, which is going through its own banking issues, unfortunately, right now, Saudi Arabia, Greece, Iran, Latin America, and the southeast of the United States. He was, as you all know, for 10 years, from 2007 to 2017, president and CEO of the Federal Reserve Bank of Atlanta, and a member of the Federal Open Market Committee. And he is currently now, which is how I first met him, a distinguished professor of practice in the Sam Nunn School of International Affairs at Georgia Tech. So let us please all welcome Dennis Lockhart.
Well, Larry, thank you very much. Delighted to be in Savannah. I've been in Savannah many times, but not exactly in these circumstances. And so thank you for the invitation. It's good to be back here. I'm going to talk about three things tonight. I know that this is the Savannah Council on World Affairs, and so there's an interest in the international dimension of American economic policy and Fed policy. But I'm going to start out by talking a little bit about the process of making policy, then give you my sense of where the economy, U.S. economy, stands today and what the outlook for Fed policy is in the near term, what, in a way, Jay Powell and his colleagues are dealing with. And then I'll close by talking a bit about how the Fed considers the international reverberations of policy, and also the role of the dollar in the world, some longer-term questions. But let me start with an anecdote and a true story. 41 years ago, I was a banker in Atlanta. I was representing Citigroup at that time. And I was invited by the then president of the Atlanta Fed, a man by the name of Bill Ford, to lunch. So I'm driving into the city to have lunch. I'm thinking, what am I going to ask him? And when we sat down to lunch and it was time to begin a conversation, I asked him, what's it like to make monetary policy? And he said, well, imagine yourself flying a small airplane, and you're in very, very low visibility. In fact, it's so bad you cannot see anything. So you have to depend on the instruments to tell you where you are and where you're going. The problem is, half of the instruments are not accurate, but you don't know which half is not accurate. He said that's what it's like to make monetary policy. And as I experienced it myself for 10 years, there is a lot of truth in that metaphor. I mean, think about, and I hope this does breed a little bit of sympathy on the part of the public that often can be critical of the Federal Reserve. Think about what they're trying to do with what they have. Data is backward looking. We're learning today, as we did this morning with the producer price index, of what inflation was in that particular measure a few weeks ago. Often it's a quarter ago. From time to time, those data are revised. We've had revisions recently that have taken the world by surprise and to some extent have adjusted the picture, at least, of what was going on at a particular time. So the data are backward looking, and yet you know or you believe that your policy decision is going to have effect on the future, not on the present, but on the future. It's forward looking. You're making policy with an outlook in mind. Wayne Gretzky said, I go where the puck is going. It's not where it is at the moment. And so you do that, but you recognize that with any given set of data, there's a lot of noise, there's methodology questions. So let me just summarize by saying it's not an easy job. It is a bit like flying blind and a bit like depending on instruments that you can't completely trust. So it's a good metaphor. So I thought I would take you to the Federal Open Market Committee and let you try to imagine yourself standing in the shoes of a policymaker, given some of the challenges that we're facing in today's economy, particularly in inflation. There are 8 meetings a year. They're roughly 6 weeks apart. Some are as short as 6 and some are as long as 8, so it's not a perfect interval between meetings. Much happens just after a meeting has concluded and a period of that interval between meetings has begun. The reserve banks, for example, and there are 12 reserve banks around the country. Savannah is in the district that is overseen by the Federal Reserve Bank of Atlanta. The reserve banks are very active going out and engaging the public in various ways to try to understand the reality of the economy as people are experiencing it at that time. The question we would like to ask people, or we like to ask people when I was there, is how are you experiencing the economy today? And what is that like? And people who are in different industries or in different roles in life are going to give you a different answer. A real estate agent is going to say one thing. Someone in an industry that's growing may say something else. And you're trying to synthesize all this into a picture of what's really happening in the economy. The reserve banks also send out a number of surveys where they are asking community leaders and business leaders their personal outlook on inflation or outlook on growth in the economy. So there's a lot done in the lead up to the week before the Federal Open Market Committee meeting. The next meeting is May 2nd and 3rd. So next week we'll begin to see that activity that takes place in the lead up. There are board meetings in which board members are expected to come with their own reports as to what they've heard is going on in the economy and from contacts they may have. Usually the Thursday before the meeting, the chairman will call around to each Reserve Bank president, and one assumes that he's also had meetings with each of the governors, try to feel out how people are thinking about policy and what it's likely to be their position at the meeting. The Thursday or Friday before the meeting, 3 options are sent out, and they are sent out in the form of a statement that would be, it's a draft statement of A, B, or C, and whatever option is chosen as the policy decision would then be communicated in that statement, perhaps with some revisions. But over the 10 years I was at the Federal Reserve, we never chose anything other than option B. So I went to 80 meetings, and it was always option B. And I assumed that the chair of the Federal Reserve, so I worked with Ben Bernanke and Janet Yellen, and Jay Powell was a governor at that, so for some of the years I was there. I assumed that the chair had a lot to do with how option B actually was stated. Not dictating, but shaping the choices that the committee was presented with. Then comes the meeting. It's a 2-day meeting, fairly formal. There are probably 60 or 70 people in the room, 19 official participants on the Federal Open Market Committee, 12 presidents and 7 governors. But 12 presidents and 7 governors. But there are another, 50 staff members who are in the room as well. And it goes fairly formally. There's a number of briefings, including an international briefing of how international capital markets are performing, how foreign economies are performing, obviously some discussion of the trade flows that the U.S. is experiencing, how the dollar is performing in foreign exchange markets, and then a briefing on the U.S. economy, and then some discussion driven by the staff as to what is likely to be the reaction to option A, B, or C, with particular emphasis on option B, since that's usually what is going to come out. And it's not a meeting where there is a great deal of debate. It's not a meeting where there's a lot of back and forth. It is 2 go-arounds where each person gets 4 or 5 minutes to say his or her piece, first on the economy and second on policy. Now, one of the brilliant aspects of this, unlike other branches of government, is you have a deadline. By noon of the second day, a decision has to be made. And a press release has to go out at 2 p.m. And under Jay Powell, a press conference begins at 2:30. So you're working toward a decision. One of my staff members at the Atlanta Fed said, and I think quite intelligently, he said, this is not a system that is truly built for consensus. It's a system that's built to get to a decision. And people will make compromises of some of their views when it boils down to option A, B, or C, where the likely outcome is going to be option B. So that's how the whole process works. And as I said, the next meeting is May 2nd and 3rd, and the questions of interest at the moment are, first, will the Fed increase the policy rate by another 25 basis points? I would rule out something stronger, and I tend to believe that they will, in fact, go forward with 25 basis points. That would raise the policy rate level to a range of 5 to 5.25%. Today it's at 4.75 to 5%. And part of the picture today that is new because of the Silicon Valley Bank developments is the question of whether the banking system is going to contract credit and basically pull back from some extension of credit, enough to substitute, if you will, for an increase in Fed policy. So that's the interesting trade-off discussion that is occurring at the moment, and it will certainly be on the minds of policymakers when they meet on the 2nd and 3rd of May. And so there probably will be voices that argue essentially the banking system is going to do our work for us, is going to help us with this inflation fight by contracting credit. And there'll be others who say, no, we don't have enough convincing evidence yet to do that. We don't know for certain that, and certainly not in a quantifiable way, that the credit environment will get tighter and more difficult, such that the banks, in effect, would do the job for the Fed. So my view is that they are going to actually conclude that they have to go ahead and make a move in policy terms because they can't rely for certain on the contraction in the banking system. The economic situation they're facing is an interesting one. We've had a lot of data this week. This is a big week for data. We've had the consumer price index yesterday, the producer price index today. We have the initial unemployment claims. I think they came out today. Tomorrow we have retail sales, which is a good indicator of spending in the economy. So this is a big week for data to give a sense of how the economy is evolving. And my sense is, and this is not necessarily happy news for the Fed that's trying to engineer a slowdown, growth continues at a better than average or better than what the economists would call trend rate. Fourth quarter was 2.6, 2.7% annualized growth. First quarter, we don't know officially yet, but there are tracking estimates, one done by the Atlanta Fed that suggests it's above 2%. So while slowing, the economy still is reasonably strong. The employment picture, again, remains tight, and the demand for labor exceeds the supply of labor. You're continuing to see some wage inflation. That's slowing, but still reasonably strong. And the inflation picture is also improving in the sense that inflation is declining, but still uncomfortably high from the point of view of the Fed as policymakers. So we got the CPI report yesterday. It did show a decline in the rate of inflation year over year. But if you look at the month over month, much of the slight decline could be associated with energy prices, and as we all know, energy prices are volatile and they can turn around rather rapidly. So I would say the inflation picture, although improving, remains uncertain. So that's what they're dealing with. And as I said, I think they will move forward with another rate increase. And after that, it's hard to tell, but I would expect that at least they will have the conditions in which they can pause, probably they would hope make a final move in May, but at least pause to observe how the economy evolves over the coming months to really get a gauge of whether inflation is going to return to their 2% target. So the question that's of great interest to this group, because this is the Savannah Council on World Affairs, is to what extent does the Federal Reserve actually consider the effects on the rest of the world, the effects on other countries of U.S. monetary policy? And it requires a bit of an intricate answer. The Federal Reserve is a creature of Congress. It was formed in 1913. Actually, the original study that was done was done at Jekyll Island. It's a great Georgia story of a number of financial leaders in various forms and government leaders taking the train down to Jekyll Island, checking into the Jekyll Island Club, designing a central bank, They were all disguised as a hunting party. You can imagine wearing fore and aft caps and having empty gun cases that they were carrying. Some would say they did more damage than you could do with guns, at least in those days. And they designed a central bank. And so it was designed over a century ago now. And the idea at the time was to duplicate some of Europe's methods for dealing with and preventing financial crises. There had been a financial crisis a few years earlier than that. We've had a mini financial scare, I would say, with Silicon Valley Bank, and I think it remains to be seen whether we're completely out of the woods, but it does seem to be settling down, so there's reason for optimism on that particular score, but I would not yet be very definitive in saying that this is something that has passed. So as a creature of Congress, and therefore an institution whose job is defined in American law, monetary policy in the United States is exclusively focused on the domestic economy. And in the meetings, when briefed about what's going on around the world or about dollar markets abroad, it is almost always a question of how will that spill back to the U.S. domestic economy, the Main Street economy of the United States. So policy is not made with some, let's just say, some consideration of how other countries are going to have to adapt to U.S. policy. What are some of those influences? First, you have a dollar market in many countries around the world, a market that operates in dollar terms independent of the U.S. economy. So it's a borrowing and lending market in those countries, and liquidity, availability of dollars through the central bank of those countries is in crises a real problem. So the Fed has put in place what are called swap lines with, I think, when COVID hit, it was something like 13 or 14 other central banks to swap their currency for dollars to provide liquidity to those offshore dollar markets so that you would not get some kind of a financial crisis developing offshore and having a contagion effect back into the United States. Secondly, the cost of dollars in foreign exchange markets has a lot of effect on the cost of living in a number of countries because major commodities are often traded in dollar terms, particularly petroleum, but also cotton and I think coffee and 2 or 3 other commodities that are important. All the contracts are written in dollars, so a country can face a sort of double whammy of having the exchange rate go against them and then the cost of the commodity in dollar terms rise. So they're very interested in the exchange value of the dollar versus the local currency. Many of the developing countries have external debt that's denominated in dollars, and as dollar interest rates rise, the cost of servicing that debt rises, which can create recessionary conditions or worse in some of those countries, depending on how indebted they are. So, and the dollar plays obviously a major role in global trade. 90%, roughly 90% of all activity in foreign exchange markets involves the dollar. So if you're in a country like Indonesia and you need Mexican pesos, you're going to do that through the dollar. And so the dollar is the intermediary currency for many of those trade transactions. So the dollar's role in the world is important, and the decisions that the Fed makes are very important. But to emphasize the key point, policy is made focused almost exclusively on the domestic so-called real economy or Main Street economy, not the financial economy per se, but the economy that affects all of us. Let me end with a few comments on the role of the dollar. And the debt ceiling question could influence the trajectory of a gradual decline of the dollar's role as a reserve currency. A few years ago, you would have measured the dollar as a reserve currency in the world at a little over 60%, say 61, 62%. The most recent measurement of that is at 58%. So there's been a very slight decline in the role the dollar plays as a reserve currency. My view is that there is no practical substitute for the dollar, no practical alternative. And therefore, the most likely scenario is a gradual decline, but not in any respect fatal decline, of the dollar's role in the international system. That the dollar in 20 or 30 years will still be, in all likelihood, the major reserve currency. Its percentage of the pie will simply be smaller, which is another way of saying the world central banks will have diversified and used a variety of other currencies as reserve currencies, but not in a way that would be, let's say, damaging to the U.S. economy. It will be a gradual process. And the main reason for that is there simply is no practical alternative to the dollar in the world system today or prospectively. So that is, in some respects, optimistic. I do not see the prospect of some kind of cataclysmic event in which China or Japan or the other major holders sell their dollars. That would be a shoot yourself in the foot kind of decision to make, because you would lose 20 or 30% of the country's reserve currency wealth in a matter of seconds, quite literally. So I think even with all of the tension between the United States and China, Chinese will continue to be very judicious about their weaning themselves off of the dollar standard, and it can only be done on a gradual basis. Well, let me end on that point, and I hope we have an active discussion with Q&A, and I'm happy to entertain any question.
Thanks very much, Dennis. I'll repeat the question just for the purposes of recording, that's all. So, please.
What consideration is given to the money supply, which we hear is contracting at a fairly fast rate?
The question is about the contracting money supply and how does that affect things? Go ahead.
Excellent question, because most of us in the room had Econ 1, right? Or Econ 101 or something. And what we were taught some decades ago was that the money supply, if it was allowed to grow too rapidly, would result in inflation. And no doubt some are familiar with Milton Friedman's comment that at the end of the day, inflation is always a monetary phenomenon and driven by growth or decline of the money supply. In my experience, we were always informed in the Federal Open Market Committee meetings of the data on money supply growth to the extent that it could be measured, or to the extent that it was reliably measured and presented. But it never had much influence on policy. Some 25, 30 years ago, the Federal Reserve gave up trying to manage policy by the growth, or sometimes the contraction, but normally the growth of the money supply, because I think at that time they just felt it was too difficult to even define exactly what money was. And money velocity, which you remember from your economic course, is equally difficult to measure, and with new forms of money in terms of credit cards and money market funds and balances in brokerage accounts and so forth, they just gave up doing that and said, we're going to just try to control the interest rate, and the interest rate will be the proxy for all these other ways that monetary policy could be done. So my experience over 10 years is that it was always interesting, but never central to the discussion of policymaking. Mike.
What could or should the San Francisco Fed have done to prevent Silicon Valley collapse?
The question was about the Silicon Valley Bank collapse and what the San Francisco Fed could or should have done to prevent it.
And you're a member of the press, is that right? This may be one that I edit.
I'm going to send you the thing.
Yeah, okay. As far as I know, and what I know is nothing more than what any of you can read. I've read all the articles that I could put my hands on to try to determine how much of a regulatory failure it was. They had identified the problems, the right problems. They were in a process of communicating those problems to the bank management and to the board. That is a process of escalating intensity of that communication, going from guidance to ordering the board to do certain things. And they were overtaken by events, maybe because their sense of urgency was not up to what turned out to be the reality that they were dealing with. There was a change of supervisory group within the Federal Reserve from one group that dealt with small banks to the next level up, which dealt with regional and international banks, because Silicon Valley Bank had grown in deposits very, very rapidly. Over a 2-year period, I think it added $100 billion or more in deposits. So there was a change of who was responsible, and at the same time a change of the vice chair for supervision in Washington, which probably created some delays in making decisions. The supervisory or the regulatory decisions are made by the governors in Washington. They are simply implemented and supported by the people at the San Francisco Fed. So San Francisco Fed would not have been able to make decisions on its own that might have prevented this from happening. So I attribute it to being a little bit slow in the process of tightening the control over the bank, or tightening the regulatory constrictions on the bank, combined with change of responsibility within the Fed, and they just got overtaken by events. Now, what would they? And the important thing is, what will they learn from the process? One thing that strikes me that this episode has really disclosed is the speed of a modern bank run, where you have the influence of social media, you have automated funds transfer systems that have no human intervention at all, which is a good thing. So once there was doubt about Silicon Valley Bank, the speed with which money could flow out of Silicon Valley Bank was just remarkable. And I read an article about CEOs of venture stage companies in Silicon Valley, CFOs, literally doing this on their cell phones while they were going to a conference in Montana or something like that. So, moving billions of dollars from their cell phone with no human intervention in the process. So I think when history addresses this particular episode, one conclusion will be This was not your grandfather's bank run, where people stood in line outside the bank and waited with their passbook to collect cash. This was a modern phenomenon that had not happened before at this speed. I think that is something that regulators are going to have to really deal with, and that's likely to make regulators more cautious about banks that have fault lines of one kind or another. So let me stop there, but I don't completely blame the San Francisco Fed. One metaphor that I dreamed up, which is not completely fair to all parties, is you're driving down the expressway, you're going too fast, you crash your car. Who is responsible? Who do you blame it on? Well, of course you blame it on the patrol, the state police, because they didn't prevent it.
You have a question in the corner, please.
Lockhart, thank you for your very candid remarks. The question I have is, why do, upon getting all the data that we see now, why do there appear to be voices that talk about a recession in 1994? In 2024. Why do we hear those voices today?
Question is, in light of all of the data that we're collecting, why are there still people out there predicting recession in 2024?
Did you say 2024?
2024, next year.
Because recession is still a risk. Now, I have tongue-in-cheek proposed that we use a hurricane kind of scale system to define recession. So there's a Cat 1, Cat 2, Cat 3, Cat 4, Cat 5. A Cat 1 recession is what actually the Fed staff effectively predicted at the last meeting, the early March meeting, or mid-March meeting, saying that they expected there would be a recession, but a mild recession. Why, with all the data we have, can't you be more precise? Because the economy is extraordinarily complex and not fully understood in terms of the internal influences one on another. And you are always operating with significant uncertainty as to what even the near-term future holds economically. So recession is very definitely a risk, and with the bank credit contraction element now in play, I would say the uncertainty level has risen recently. So it's even more uncertain what will actually develop. The longer we are dealing with inflation, the more persistent inflation is, and we've already seen this, the higher they're going to have to take the policy rate in order to, and maybe the longer they will have to hold it at that level in order to get inflation under control. And it simply raises the risk that a recession develops. My private view is that you're not going to hear policymakers say it, but they probably would accept a mild recession if it very definitely brought inflation down.
Yes, question in front.
Yes. I'm curious about the policy objective of 2% inflation, what the origin of that was, what it comes from, and does the Fed ever consider it as to whether it should increase it or decrease it? And why isn't it 0%? And in effect, is that a functional equivalent of a 2% tax annually on almost everything?
So the question was about the using a 2% standard for inflation as acceptable inflation. Why is it 2% and not 0%? And isn't that a 2% tax on all of us?
Very, very important question. So thanks for asking it. First, why not 0? Because if you think about it, 0 inflation is on the cusp of deflation. Central banks, maybe you will argue with this given history over the last 2 years, but central banks sort of know what to do. They have a playbook for inflation. It's much harder to deal with a deflationary spiral. That's what the Great Depression was. And a deflationary spiral is deflation feeding on itself because spending dries up and people believe that if they just wait, it will be, whatever it is, it will be cheaper. So over decades, literally, the view has developed that a low rate of inflation is consistent with healthy growth. And very importantly, if it's at 2% or some low number, it will not factor into decision-making of businesses and households because it's such a gradual process. It's not something that you would have to factor into every decision you make. 2% became the international standard, and a number of banks adopted an inflation target well before the Fed did. The Fed was one of the later banks to actually adopt an inflation target. Ben Bernanke was an advocate. I was at the meeting when we finally made that decision. It was not necessarily agreed to by everyone at the table, but Bernanke convinced the committee that it was now appropriate, and this was about 2011 as I recall, to adopt an inflation target and make the Fed an inflation targeting central bank. There is an element of convenience to 2%. It's a round number. It would be much harder to embed in the public consciousness 1.94% or 2.31% or some number like that. So the fact that it's a round number and is viewed as, on balance, a healthy rate of price increases really had an effect, but there's an arbitrary aspect of it. At the meeting, there were those who advocated 1.5%. Others, in the meantime, who've said we should have a higher number, as you referred to in your question. I don't think, and Jay Powell has said as much in response to questions in his press conference, that they're going to seriously consider changing the target. Ironically, for the 10 years I was involved in monetary policy, our real challenge was getting inflation up to 2%. And that's why we had a low interest rate environment for so many years. From December of 2008 to December in 2015, the policy rate was effectively zero. And during that period, only a couple of quarters did we ever see inflation above 2%. It was mostly a struggle to try to get the economy expanding at a pace that would push prices at a 2% pace. The tables have been completely turned on them. Now the problem is getting inflation down. And your question is a common question in economic circles of whether the 2% target should be 3% or 4% even. Some very serious people have proposed 4%. But I just don't see them making that decision. Too much has been invested in the 2% target.
Could you explain what the shadow banking is and how it relates to in the financial system compared to commercial banking?
Shadow banking.
What is shadow banking and how does it fit into commercial banking?
Well, the United States financial system, unlike Europe, is not bank-centric. There's a whole sector of the financial system that involves accounts at brokerage companies like Charles Schwab or others that then invest in money market funds that then in turn invest in short-term instruments of various kinds, including treasuries. it's a banking system in a certain way. I think you could also argue that the financial technology or fintech sector, which is most, let's say, most impactful in credit and payments, is an element of the shadow banking system. And there are non-bank payments companies, PayPal comes to mind, for example, that offer wallets, which are effectively like deposit accounts, and in some cases they are guaranteed by the FDIC. This is not a banking company per se, it's a payments company. One of the conclusions I've drawn is that it's a kind of an interesting competition between the bank account world and the wallet world, but many young people don't have bank accounts any longer. They simply operate with their payments company wallet and keep any excess funds they have in that wallet. And we have a financial system that is much deeper than any other in the world in terms of the issuance of securities of various kinds, from treasury securities to mortgage-backed securities to corporate debt to corporate equity. And that creates a wealth reservoir kind of system that competes with the banking system for long-term bank deposits and certificates of deposits and so forth. So we just have a much more diversified banking sector than, as I said, than Europe has, which is much more bank-centric. Regulators have authority over the banking system, but not uniformly over the shadow banking system. So there can be risks that lurk in the shadow banking system, partly because it's less supervised or less regulated, that have worried people in the past. They've worried about a modern run, if you will, on a money market fund. And we've seen back in 2008 some kinds of incidents that were like that, where people started withdrawing money faster than they could liquidate their assets and would create an insolvency, if you will, in a money market fund. That remains a concern. The legal authorities have not been broadened enough to encompass everyone who participates in the financial system. So there are aspects of the financial system that are less regulated or unregulated or regulated by the SEC, which has a different kind of outlook than necessarily the bank regulators do. I guess I should also mention the cryptocurrency world as part of the shadow banking system. I've read a ton about cryptocurrencies. I am not an owner, and I am on balance a crypto skeptic, but it's not going away. And consequently, it will be an element of how our financial system works and plays different roles in payments, sometimes as a safe haven when people want to get out of the dollar or they get into a cryptocurrency. And where everybody's aware, there are illicit practices as well that can take place in the crypto ecosystem. So you cannot exclude that from a definition of the shadow banking system.
Next man here in the sweater, right here, striped sweater.
I'd like to go back to SBT just for a second, because I don't think it's one-off. I think it is a symptom that is in the banking system, and risk management is the key. They got hot money, and they invested it long-term. And that the savings and loan industry went out of business over that. And I don't believe SBT is the only one that's got that problem. They got $1 billion in money in deposits, hot money, easily moved out. And they put it into long-term treasuries and bonds, not short-term. My broker would cut my... just wouldn't do that, and I completely concur with that. And SVT, or the there ought to be one of those instruments in the airplane that ought to be pretty clear. What is your deposit rate, what you got your deposits invested in? Is it how long term versus how hot is the money you got invested? Is that not?
Yeah. The essence of the question about Silicon Valley Bank is that the question was saying this is not the only one out there. There may be others. They were getting hot money to do very long-term investments. I think the premise is that they were not being watched as they were doing this, or maybe even internally watched or careful enough.
But that ought to be observable with one of those instruments. That ought to be fairly precise. How much money you got.
Right. There should be very much a standard or an instrument like that to control and prevent this from happening again.
That's my simple understanding. I was looking at.
And I hope you're wrong, but I don't totally disagree with you that this is not a one-off. But I do think you have to look at Silicon Valley Bank, and I'll frame the question. Was there a special set of circumstances or a unique set of circumstances associated with that bank that are not widely duplicated in the banking system? And I think that argument can be made. First of all, the speed of deposit growth concentrated in uninsured deposits, further concentrated in a relatively few venture firms or portfolio companies of venture firms. And as you pointed out, with that growth, that they could not keep up with loans, making loans, so they ended up investing in U.S. Treasuries or mortgage backs, but they decided to go longer tenor in order to earn more. Concentrations built up on both the asset and the liability side of the balance sheet. They did not have a risk manager in place. And that is, there's a position on the org chart that was not filled for some period of time, which may have detracted from management's attention to this risk. So I think you can make an argument that there are similar problems, but not as extreme in the banking system. With the rise in interest rates, no question that there are unrecognized losses on the balance sheet of many banks. But they had over 45% of their total assets in investments, not in loans. So, or they have 55% in loans, but a normal ratio would be about 15 to 20% in investments and the remainder in a loan book. So I think you can make the argument that Silicon Valley Bank is a special case, but with elements that should get the attention of managers and regulators elsewhere in the banking system.
My only argument with that is that it happened in the early 1900s, early 2000s with the savings and loans. They went out of business over it. It's not a new phenomenon.
Yeah, but those.
You mean bad bank management is not a new phenomenon?
No, not in long-term investments.
Well, keep in mind, let me make one more comment. This is a little bit more philosophical. Banks are fragile entities that can only hang together based on trust. So if you lose trust, much can unravel in a bank. So think of the picture of a bank. It is 10 to 12 times leverage. That is equity capital to deposits and other forms of liabilities. It is in the business of what economists call maturity transformation, taking short-term money and turning it into longer-term in loans or investments. That's what banks do. And it is I hesitate to use the word bet, but let's just say it is a dependence on liquidity based upon the law of large numbers. And that's a fragile picture. And yet that's banking as we know it. For any bank, anywhere in the United States, at any scale, they have some of those characteristics. So Every once in a while, you're going to get a case where that trust is destroyed and destroyed quickly, and then that fragility expresses itself.
Signature Bank was also like SVB.
Signature Bank had a lot of exposure to the crypto world. It also had grown rapidly.
Just not crypto itself, but the deposits of crypto.
Yeah.
Yeah.
Please.
With the large increase in interest rates, of course, that costs a lot of money to service our national debt. Where's that money going to come from, and what's the Fed's take on that?
Where does the money come from to pay an increasing debt based on the interest rates? And
So the questions here are getting more and more pessimistic. Now you're into the fiscal world. You know, I made reference earlier to the debt ceiling question, and Jay Powell has said this, and I couldn't agree more. There is no other option. But certain members of Congress are going to play with fire right up to apparently the last feasible moment. And if there is an accident, an error that causes a default, then we have much, much bigger problems, because the centrality of the dollar is not going to be eliminated, but it's going to erode more rapidly than I described earlier. On the debt service, here's what I understand. First, it's now the fourth largest outlay in the federal budget, and may shortly become the third. So you have entitlements, Social Security and Medicare, principally those two, some others. So take that as one sector. You have defense, which is about $840 billion, something like that. And by some calculations, the interest in the near term on the national debt could be in the neighborhood of $800 billion. It was 485 for the last fiscal year, but in the first quarter of this fiscal year, it was about 200. So if you annualize that number, which is probably not, not the simple, it's too simplistic, but if you annualize it, you're getting close to $800 billion. So it's not an unserious question. So where's the money going to come from? Here's where I get really, I share, I think, probably your concerns and many in the audience. I'm just not seeing an easy way out, or not seeing an easy answer. If you're going to try to cut expenditures to cover debt service, you're dealing with a portion of the overall federal budget that is 33% or 30% of the federal budget. And we can cut those departments. In fact, one calculation I think done is if you wanted to balance a budget in 10 years and you did not touch entitlements or defense, then you have to cut the rest by 85% to get there in 10 years. That gives you a sense of the degree of the problem. So Savannah is an aerospace center. Do we want the FAA cut down further so we're having air crashes? Do we want the oversight of new drugs and so forth to be cut? Do we want the infrastructure budget to basically go on the shelf completely? I just don't see an easy answer, quite frankly. But logically, if you have a rise in debt service, you either raise taxes or cut expenditures or both. Or you keep deficit spend, just keep spending and creating deficits, and debt grows. None of those scenarios is a very good scenario.
well, maybe one last question in the back, the gentleman in the
Explain the
back.
role of the Fed in buying so much of the U.S. debt, and where do they get the money to do that?
I'm sorry, who is playing the role?
Can you explain the role of the Fed in buying, I think they're the
the question is about the role of the Fed as the owner, the buyer of the more U.S. debt, and where did they get the money to buy that debt?
Another really good question. I'm glad you asked it. I'm going to have a little fun with the question. So in 2008, by the end of 2008, we, the Federal Open Market Committee, had taken the policy rate from over 5% to 0. So basically the opposite of what's happened in the last year and a half. When you can't go any further in terms of your interest rate, your policy interest rate, and you want to add more stimulus, you don't have a lot of options. And Ben Bernanke at that time, whom I admire immensely, raised the idea of quantitative easing, QE. I thought QE was a boat that goes between New York and so I had to become a quick study on the whole literature around quantitative easing. And we have had various phases of quantitative easing. Now we're in a quantitative tightening, the reversing of that. What is that all about? Well, first of all, what's fun about it is central banks can do something that no other institution can do, and that is they can create money, poof, from nothing. And so quantitative easing involves creating new money in the form of bank reserves and buying securities from the market and crediting the account of the bank that you're buying from with the new money. So the balance sheet of the Fed when I joined in 2007 was about $800 or $900 billion. While I was there, it rose to $4.5 trillion. Then it backtracked a little bit, and now it's almost $9 trillion. It was declining gradually. That's quantitative tightening. But recent events have required that the Fed provide liquidity facilities that have again grown the balance sheet to close to $9 trillion. Quantitative tightening is simply reversing that. And that is when the securities mature, treasuries or mortgage-backed securities, when they mature and you get paid, you destroy the money. That's what it amounts to. And that money goes out of the system. Now, a lot of people are concerned, and legitimately so, and would point to that era as being inflationary because the Fed was creating new money. But a lot of that was really very passive money that stayed on the balance sheet of the central bank. It did not get out into the active part of the economy, the part of the economy in which we operate. It simply hung there as bank reserves. And as we go through quantitative tightening, those reserves will come down. But we're still going to have a much, much bigger central bank balance sheet than we had in history when I started, for example, and for most of the decades before that. So it's a very good question, but the thing you should take away is remember central banks can do something that no other institution can do, and that is create money out of nothing.
I think you'd all agree with me with that.
That's a happy note, don't you think?
That's right.
We have some.
Thank you. Thank you very, very much, Dennis. I think you'd all agree with me that we've been the great beneficiaries of wonderful experience and thoughtfulness. So, Dennis, thank you very, very much for being so generous with your time. Thank you. If I could just mention the upcoming program that we have on May 18th, which importantly, look, it will not be here. It will be in a downtown location at the Coastal Georgia Center on Farm Street. Scientific cooperation in cutting through the South China Sea deadlock with Dr. James Borton from the School of Advanced International Studies at Johns Hopkins. So I hope that you'll all join us. And one other thing we try to make at the council, we try to make these sessions as responsive as possible to your wishes. So in June, you will be seeing a survey coming out to all of you from us on the topics that you're most interested in learning about. So please look at those. You can choose whichever ones you'd like. You can write in other subjects that you would like to hear about in future guests, with future guests. Thank you all very, very much for coming.